When it comes to getting that new vehicle you've always wanted, does it make sense to buy the vehicle? Does it make sense to lease it or finance it outright? In today's video, we're going to be breaking down the options so you know the difference because it can be a very complicated choice. Now, on one hand, if you're buying the vehicle itself, it is going to come with a higher cost than we traditionally see from leasing, but you own the asset at the end of it. If it's a car that you've always dreamed about, you own it outright when you make those payments. On the other hand, leasing usually has a lower monthly payment, but it could have a much higher upfront charge. And then, of course, once the lease is ended or terminated, you give the vehicle back to the lessee company. So in today's video, we're going to be breaking down all three options and really figuring out what makes the most sense depending on your situation. So the first one we get into is getting a conventional car loan. This is going to your bank, going to your credit union or another lender and borrowing money to buy the vehicle. This means you're not leasing it, you're not essentially borrowing it, you're buying the vehicle, it is going to be yours, and you're committing to a certain term over a certain rate with a set payment. So for instance, if you're borrowing $50,000 and you're paying 5% over 5 years, your payment is going to be X amount. A chunk of each payment goes towards interest. Part of it goes towards principal, just like a traditional loan. Now, the higher the interest rate, the higher the payment on that vehicle is going to be. Also makes a big difference with the purchase price of that vehicle, which of course you can also build equity. That is one of the things, even though a car itself, generally speaking, is a depreciating asset. When you start putting miles on it, when you start doing wear and tear, when you start aging the vehicle year after year, the value of the vehicle is going to essentially go down every single year as a depreciating asset, whether you have it as a lease that you're just going to give back or as a loan or as a vehicle that you own. This makes a big difference because how you handle your vehicle, how you maintain, how you take care of that vehicle can be completely different from people who buy it, from people who lease it. Now, me personally, I do buy all my vehicles because we do pay them off fairly fast. And then we do have years and years of essentially no car payments. Now, on the flip side of this, with the lease, buyer makes a monthly payment to drive a new car for a set term. Most of the leases here in Detroit are 24 to 36 months is what we normally do. But a lot of those, to get a lower payment, people are putting down a lot more money. So if you've seen some of the commercials, if you've seen some of the car ads where, hey, you can drive a new Cadillac for $500 a month, but you need $10,000 to drop to get that payment to the $500. So you have to know exactly what you're getting into with the lease, what termination fees, what mileage go behind those. So make sure you know kind of all the in and outs of the lease itself. Now, when you start thinking about the consumer loan, just getting a traditional loan like we were talking about, you don't have to worry about the miles. You don't have to worry about really what you do. No repair, no excessive repairs, or anything that can go with a lease. So what are some of the upsides of leasing? Now, this is where it kind of does get kind of cut and dry. When you think of a lease, you don't have to worry about the maintenance of the vehicle. This, of course, can be huge for a lot of people that don't want to worry about the maintenance of the vehicle, don't want to worry about the cost, and they also want to have a newer model vehicle. Most of these plans will include service and maintenance plans for the vehicles because dealerships want the vehicles back in pristine condition so they can take them and they can resell them. So you could have many trouble-free years of leasing them. Also allows you to drive the latest make and model because, of course, most of those manufacturers will cover those vehicles for an extended amount of time. And of course, you can drive a much higher priced car. You talk about keeping up with the Joneses, you talk about lifestyle creep, where if you're sitting on a budget of a $30,000 to $50,000 car, you could go ahead and lease a $70,000 or $80,000 car, putting some money down. You can have a better equipped ride or better vehicle than you can actually afford based on your budget. Has the latest safety features, all the bells and whistles, all the navigation. There could also be some tax advantages for business owners. And at the end, guess what? You give the keys back, you're done, the lease is over, you guys part ways. But unfortunately, a lot of times that might not be it. A lot of places that we see, and this is the big disadvantage with these leases, you usually cost you a lot more upfront, which again is crazy, and they are rapidly depreciating. And if there is any damage to the vehicles, we have seen everything from chips in the paint to windshield chips to tires needing to be replaced. We're talking about 30, 40,000 miles on a leased vehicle. The dealership's already claiming that the tires need to be replaced or other things physically have happened to the car, and they are charging you money for everything that happens. Now, of course, the biggest disadvantage, like we were talking about, monthly payments go on forever. There is no point that your lease is paid off in the entirety. Even if you pay the lease up front, you might have 2 years, you might have 3 years, then you're right back to either getting another lease with another car payment, or you're looking to buy that lease out and going to that conventional loan. Now, of course, leases do have a limited number of miles. When you start looking at those great deals you see on TV where it's $400 for a brand new car, boom, it might only be 4,000, 5,000, 6,000 miles. You have to be cognizant of your driving patterns, how much you're really moving that vehicle, and what is a lease going to cost you. We have seen the mileage over a set amount go from 10 cents to up to 50 cents per mile driven over the lease. And essentially, a lot of people had to buy out the vehicle because it would have costed them way too much to turn the lease in, which is kind of crazy. Other thing to remember with this is if you decide you don't like the car or like the vehicle that you're leasing, chances are there are a ton of early termination fees. Most of the leases you can't get out early without having a lot of penalties that will be due all at once when you turn that vehicle in, which again, you have to make sure you don't want to be on the hook for any of the leasing things. Now, when it comes to the conventional loan, and I want to cover this as a financial counselor, as someone who has spent 18 years in the financial industry, an alternative to longer car loans. So what we've seen traditionally is 60 months. You got 5 years, you pay this car back. Cars have gotten to the point that they are so expensive that people are starting to do 6 years, 7 years, 8 years. Today, we have even seen 9 years and 10-year loans. Now, like we said earlier, auto loans are a large depreciating asset. If you're taking the vehicle out for a 10-year loan to get a lower monthly payment, chances are every single year that that car is depreciating, you are going to owe more and be upside down in that vehicle for every single year that it depreciates. Meaning when you go to pay that loan or when you go to sell the car, chances are you could owe thousands or tens of thousands of dollars ultimately on the vehicle that you're trying to get rid of, which makes it incredibly hard. And also, if it's destroyed, if it's lost, if it's stolen, if something happens to it, the insurance companies only pay a fraction of what it's worth, which again, dealing in automotive and being in the financial institutions, we have seen a lot of people that are completely upside down with vehicles, meaning that again, they owe thousands, if not tens of thousands of dollars on a vehicle that they no longer even have, which is kind of crazy. This is, of course, where things like gap insurance and a few other things come in. Now, buying a new car loan, if you don't want to go and buy it every couple years, this is where the used market comes in. Me personally, I absolutely love some gently used cars because a majority of the depreciation driving it right off the lot, brand new from the dealership, is already depreciated. The first time you drive it out, roughly in some of the vehicles, we're seeing a 15 to 25% depreciation, which is incredible when you think of a $100,000 car. If it's dropping $15,000 to $25,000 off the lot, it's kind of crazy to think. Now, of course, to get your payment down, if you don't want to finance as much, if you want to get ahead of that depreciation, you can always put cash down, not only lowering your monthly payment, but also allowing you to have it for essentially a less time. Me personally, I wouldn't do anything over a 5-year lease. When you start looking, or excuse me, a 5-year loan, when you start looking at 5+ years, and again, getting into 6, 7, 8 years, the depreciation is going to be there. And ultimately, if you cannot afford the car on the monthly payment within 5 years, you're probably buying a car that is a little bit too expensive. Maybe instead of a $50,000 to $80,000 car, you look at a 30 to 50 just to make it feasible. So again, between here, the only thing that is really difficult to compare is really the head-to-head comparison of what it looks like buying a vehicle and owning a vehicle and also leasing the vehicle, because it is up to yourself and it is up to the habits that you have. Again, if you're an individual that is going to essentially finance a car and you're going to keep it about average is 27 months, but if you're going to keep it for a very short term and you're turning over cars every 2 years, chances are you're not going to build any real value in the asset, even though it's depreciating. But a lot of people are turning cars over very fast, where lease might make a little bit more sense. And if you're looking at someone who is, not car savvy, doesn't want to worry about it, always wants to have a reliable car, there are a lot of newer cars that you can lease that are not super expensive. Now, of course, these are not the cars that are, the $80,000 cars, but looking at a few of the basic models like a Trax or a Jeep Compass, things of that nature, they're very affordable and you can also lease them for a relatively low payment. And if you do want to get into that, you can also finance or do a lease buyout when the lease is completed in its entirety. So when you think of back-to-back leases, this is where people can spend thousands of dollars going back to back to back, not only with the payments essentially that you have with the lease, which of course are lower than financing, but you also do have those upfront fees and you have disposition fees. There's a lot of things that are built into leases that people are not aware of that can make these a lot more expensive. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.